$79 billion, or 38% of King Solomon's $2.1 trillion net worth was gold. Why? King Solomon was considered to be one of the wisest men that ever lived. He's 10 times richer than the richest man that lives on earth right now. In a world where market volatility lurks around every single corner, it's time to discover why gold should be the shining star of your investment or retirement portfolio. Hi, my name is Tommy Cloud. I'm president of Third Act Retirement Planning. It's a company that I started back in 2000. I am a certified financial planner, qualified Kingdom advisor, and when I was in college, I got a degree in finance as well. Today, we're going to be talking about gold and the impact that it can have in your portfolio. As an expert in retirement planning, I'm here to guide you through the timeless allure of gold as an investment and reveal how it can transform your retirement strategy. From the benefits of gold in retirement to practical tips on investing in gold, we're going to explore the truth behind this precious metal's enduring value. So whether you're a business owner, a single woman, or a couple planning for retirement, this video promises to be your trusted path to financial security with gold. Join us as we delve into the essentials of gold retirement strategy and investing strategy, and don't forget to share your thoughts on gold investments in the comments below. Plus, stay tuned for more insights by watching our next video. First of all, let's discuss the historical significance of gold. Gold has been revered throughout human history as a symbol of wealth and prosperity. It's also said to be on heaven. The streets, heaven is supposed to have the streets of gold, and that's in the book of Revelation. That is, of course, if you believe the Word of God, or the Bible, as some people call it. From ancient civilizations to modern economies, gold's value has remained remarkably stable. It's been used as a currency, a means of trade, and a reliable preserver of wealth. The allure of gold stems from its unique properties. It doesn't corrode, it's malleable, and it has a distinct luster that has captivated cultures for millennia. Historical trends show that during times of economic turmoil, and we're going to look at that in detail, gold often retains or even increases its value. We're actually going to look at 6 or 7 financial crises or economic crises or disasters that have happened since 1972, and we're going to see how gold performed during those time periods. And the way that it performed during those time periods has made it a dependable investment choice. The other thing that you need to know about gold is how it acts as a hedge against inflation, which is so important in the world. All the government's resolution or the way that they're going to resolve a recession or depression is just to print money. They love printing that money. When we saw COVID come around, trillions and trillions of dollars was printed. And then it began to show up in mass inflation at the end of 2021 and all of 2022. Inflation is the silent thief of purchasing power, eroding the value of hard-earned savings over time. For those planning retirement, inflation can significantly impact the real value of your savings. Gold, however, has historically acted as a hedge against inflation, especially since the US dollar came off being backed by gold in 1971. During inflationary periods, gold prices often rise, which, of course, preserves the purchasing powers of those who invest in it. For example, during the high inflation of the 70s, gold prices surged, demonstrating its effectiveness in protecting wealth.
Okay, so Solomon also said, divide your portion or your wealth to 7 or even 8 ways, for you do not know what danger may occur on the earth. Now, this is Ecclesiastes 11:2 from the Old Testament in the Bible. What he says is nothing to sneeze at. Not only did he have 2.1 trillion, but if we read in the Bible, Solomon only asked God for one thing, and that was wisdom. And apparently God gave it to him. He chose to have 38% of his money in gold. Why? I believe the reason why is because of the diversification that it offers. Diversification is a key strategy in any investment to manage risk. By spreading investments across various asset classes, you reduce the impact of a poor performance, which impacts the long-term returns on your portfolio more than anything else in any single investment. Gold complements traditional investments like stocks and bonds. It has a low or negative correlation with other assets, meaning when these assets decrease in value, gold often increases or even remains stable. Including gold in your portfolio can reduce overall risk and volatility, creating a more balanced and resilient investment strategy. Let's take a look now at what it would look like with gold and U.S. stocks in a portfolio together and why that might be beneficial to you. Okay, so we're going to look now at both U.S. stocks and gold and how both of them have performed individually and together since 1972. And I think you'll begin to understand, if you don't already know, the benefits of gold and why we talk about diversification so much. U.S. stock market here is the first portfolio, and I've just called it all U.S. stocks. The second portfolio is going to be called all gold. I guess I could have called it solid gold as well. And that's going to be 100% gold. And then we go down here, we got 50-50 U.S. stocks and gold split. So we put 50% into both U.S. stocks and gold. And again, this goes back to the first full year after the U.S. dollar came off the gold standard, which was, of course, we're going to start with January 1st, 1972. Let's get right into it. As you can see, U.S. stocks performed at 10.74% per year on average. Of course, we're catching that right now at the end of a very massive uprun. A 20% correction from where we are now would dramatically change this number. And then we have all gold. Gold's also gone up a lot over the past 12 months. We'll look at that in this video. So that's driving this number up to close to 8% per year. Interestingly, when we put the two together, instead of it being the average of these two numbers, which would be 9.35% a year, you can see that it's 10.52% a year when you take gold and stocks and put them together in a portfolio over a 50-year time period. Why is that? Well, that's the true benefit of gold. Gold is a great diversifier. Well, diversifier is just a word. What does it mean? Well, it means that gold helps the portfolio not have big losses. Why do we want to avoid big losses? Because big losses impact long-term performance on your portfolio more than big gains help. Nothing will impact the value of your portfolio and my portfolio and the wealth that God has given us than these huge losses. If you have $100 and you lose 50%, you have $50. If you have $50 and you gain 50%, you only have $75. So you must gain 100% from a 50% loss to get back to break even. And that's the reason why. It's an intense thing. It's a very intense thing. And that's why I present it that way. If you look, the worst year for stocks was 37%. And for gold, it was 33% since 1972. However, the portfolio with gold and stocks together only went down 18% roughly. And I'm just rounding these numbers up or down. The max drawdown, and a drawdown is we take the peak no matter where it is to when it finally hit the bottom. And I think for stocks in this example, it's going to be like November of 2007 to February of 2009, just to give you an example. That's about 15 months, for example. But a max drawdown, it could be anything. It could be a 3-month time period or a 5-year time period. Gold went down 62%, and I believe that was like in 1980, 81. 62%, but a portfolio of both gold and stocks only went down 33%. Why is that? So we see why the performance is not 9.35. The answer is because the max drawdowns and the amount that a portfolio will crash, so to speak, is not as severe when the two are combined together. That's the beauty of diversification. The two together perform better than they could alone if they're identical returns. But in this situation, gold's far less. It's about 3% less per year than stocks over that 50-year time period. And yet, when you put them together, stocks only fall down by 0.2% over a 50-year time period because of the beauty of diversification. Why is this right here? It's very simple to answer that question. I'm just going to scroll down here and show you very quickly the answer. The benchmark correlation. As you can see, gold has a 0.03% correlation to stocks. What does that mean? It means this. Gold is not correlated to stocks. Gold has no correlation to stocks. Gold does not care what stocks do, is another way to put it. I sound like Johnny Cochran. But here's the thing. Because of that, gold can do and help the portfolio still perform well. Now, bonds don't have a correlation to stocks. Cash doesn't have a correlation to stocks. But bonds and cash don't have an 8% per year compound annualized rate of return over 50 years like gold does. So no correlation. That's why all this works. It's so beautiful. It's so wonderful. We're going to scroll down here and I want you to look at the max drawdowns here with gold. Like I said, we were going to look at, okay? 1, 2, 3, 4, 5, 6, 7 disastrous time periods or economic disasters or recessions, depressions, whatever you want to call them, since 1972, and U.S. stocks only outperformed gold one time, and that was during the Asian crisis. They only went down 4%, while gold went down about 13%. That was the only time. Every single other crisis since January 1st of 1972, gold has performed better than U.S. stocks. Final thing I want to show you is the time period that you're underwater. And we look at a portfolio with only U.S. stocks, and And this chart really doesn't show it appropriately in my opinion. But if you look at US stocks from peak to when it got back to break even, 1929 to 1954, that's 25 years. 1966 to 1982, that's 16 years. 2000 to 2013 is 13 years. Now they really don't show it here because there was a time period where gold kind of inched above its, stocks inched above its high in one of these years. I don't know when it was, if it was 2005 or something like that. And then it went right back down. So I don't count that. It took basically 13 years for you to make any money in stocks. Now gold's even worse. It was underwater for 26 years from October of 1980 to August of 1999. Who wants to wait 27 years to get their money back? I don't know of any investor that does. And then you have another time period, gold was more recently underwater for 9 years, from September of 2011 to July of 2020. And 26 years, I'm sorry, that was October of 1980 to April of 2007. I need recovery buy is the most important thing. Sorry for that misquote there. But the important thing is to look at how they perform together. What's the longest they were underwater when they performed together? For US stocks, it was 13 years, and for gold, it was 26 and a half years. So for drawdowns here, the most the portfolio was ever underwater was 5 years. And that was from December of 1980 to November of 1985. That's not nearly as long as 13 years or 26 and a half years, is it? That's much more palatable. And that is the beauty of putting gold in your portfolio. It won't work as well with bonds. Bonds aren't correlated to stocks either, but bonds don't perform as well as gold. And that's why we call it a hedge, because it has no correlation to the global stock market. And one final comment on this screen share section. I didn't include international stocks because it has an 88% correlation to US stocks. Okay, so let's continue with the benefits of gold in retirement. Gold brings a unique stability to retirement plans. As a physical asset, it provides peace of mind that few paper assets can match, or even physical assets can match. As you look at single family homes and real estate, we now see that insuring a home is extraordinarily expensive and even difficult to do in some places. With all the increase in natural disasters, even single family real estate, single family homes and real estate is becoming more and more risky. Gold is also highly liquid, meaning it can be sold easily to meet any financial needs during retirement. Its long-term security advantages make it an attractive option for those seeking to protect their nest egg against market uncertainties. A gold retirement strategy or investment strategy ensures that a portion of your wealth is safeguarded against unforeseen economic shifts, as we looked at earlier. Different ways to invest in gold. Investing in gold can be approached in several ways, each with its own set of benefits. Physical gold, such as coins and bars, allows investors to hold gold tangibly, most likely at their home or in a safe or a safe deposit box at a bank. Gold ETFs and mutual funds offer a more liquid and flexible option. It's ideal for those who prefer not to handle physical assets. Then you have the gold mining stocks and futures, which we don't get into as much, but that can provide leveraged exposure to gold prices, though they come with extraordinarily high risk, particularly those gold stocks. Those are, and futures, but the gold stocks are just jet fueled. I mean, those can go down 80% in 1 year. Understanding these options allows investors to tailor their gold investments to their specific needs and tolerance. To understand the gold market is influenced by a variety of factors, including global economic conditions, interest rates, and geopolitical tensions. Currently, market trends indicate a strong demand for gold as investors seek safety amidst economic uncertainty. It's been a while since we've had a recession. Expert opinion suggests that gold's safe haven status will continue to drive demand. Staying informed about these trends is crucial for making informed investment decisions and optimizing your gold investment and retirement strategy. We've used gold in our clients' portfolio since we started back in 2000, so we've never had a year that we didn't use gold. We've used gold all 24 years that I've been in business, and I've found it to be extremely beneficial to my clients long term. So how is gold taxed? Well, gold is classified by the IRS as a collectible, similar to art or rare books. So this classification subjects gold to a maximum long-term capital gain rate of 28%. The short-term versus the long-term gains, if you did hold gold for less than a year, any gains are just taxed as ordinary income, which can be higher than the long-term capital gain rate, of course, depending on your particular tax bracket. So the risk and considerations for gold, we've kind of been talking about these all the way through, but I just want you to know that, while gold is a valuable asset, it's not without risk. There's market fluctuations, there's storage costs for physical gold, and there's the potential liquidity issues that will become factors if you own it physically at your home. Mitigating these factors involves diversifying investments, investments, using insured and approved storage facilities for physical gold, and staying informed about market conditions. And there are places that you can have physical gold in fungible programs if you don't want to do an ETF, and I suggest that you Google those and get into looking at different fungible programs. Making wise decisions requires ongoing education and consultation with financial experts. In conclusion, I would say that gold plays a critical role in retirement planning and investment planning by offering stability, diversification, and protection against inflation. As you consider your financial future, incorporating gold as an investment can provide a strategic advantage. Share your thoughts on gold investments in the comments and learn from others in the community. Keep exploring the potential of gold by watching other videos and learning more about this timeless asset class. We'd love to hear about your experiences with a gold retirement or investment strategy. Comment below with your insights and thoughts. Don't forget to watch our upcoming videos. Subscribe to our channel for more expert advice on financial strategies, and stay informed about the latest trends in investment, retirement, financial, and tax planning. From Sudden Wealth Stewardship Channel, my name is Tommy Cloud with Third Act Retirement Planning.